Thank you. It's great to be with you all today. So I'm Charles Casey from Solaris Investment Management, and as Mark said, here to talk to you today about our Australian Equity Income Fund. There's several topics I'd really like to dive into, and the first of which is our focus on yield and franking, which is a big focus of our income fund. The second of which is our focus on growth, and the third of which is how we invest for income at Solaris. So let's dive into our focus on yield. Yield is a really big part of what we're looking to achieve in our income fund. And how are we doing this? We're investing in productive ASX-listed companies and harvesting dividends and franking credits out to our investors. The fund distributes yield out quarterly to investors, and it's really targeted at zero tax rate investors, low taxpayers, or investors that are looking for a higher yield or higher franking outcome than our core Australian equity fund. So over time, this is the fund's yield in orange and the ASX 200 in blue. So we've delivered a yield in excess of the benchmark, which is what we're looking to achieve over time. And that's a gross yield, which includes franking in orange. So over the past year, 12.95%, and since inception, 8.9%. So a large focus on yield and franking. We can have a look at this a little bit more. This is a yield across the banking sector throughout time. So the banks have generally been a good source of yield, but also a source of franking credits. There's been times to be more active in harvesting yield and franking from the banking sector, but generally a healthy level of yield and franking over time. More recently, it's been the miners and the resources space over the past 18 months, generating really super profits, paying tax, generating franking credits, and distributing it out to investors. So we've really liked the shareholder-focused capital management strategies of the miners that have been returning a lot of this surplus capital straight back to shareholders, which has been a great outcome. So we've been harvesting yield from the mining sector, in particular over the past 18 months. But as we all know, it's very cyclical. The yield out of the sector is not going to be there forever. It has, you can see, been quite low in the past. It's quite high now. It won't be there forever. So BHP's dividend was cut around 40% over this period. Iron ore prices really fell away in the third quarter of last year to around $85 a tonne and are back up to 130. So there's still some healthy yield and franking that's going to come out of the mining sector as we look forward. We're up here in August last year with this slide talking about the risk of dividend cuts on the horizon. So we were talking about a couple of key factors, the first of which is over-leveraged corporates and the risk around dividend cuts from higher interest costs. And that has started to play out. So specifically within the real estate sector, we've been underweight. And what's happened is a lot of these companies have managed to pay a stable dividend or even a higher dividend, but have increased their gearing and their debt levels to do so, which from our perspective is an unsustainable strategy in this rising rate environment. Another area is the consumer discretionary space. So it's not limited to retail, but any stock or company that has a lot of inventory or normalisation in spending and buying patterns post-COVID is at risk of coming off the back of a peak level of earnings to more normalised post-COVID earnings and more normalised post-COVID dividends. So we still see risk of dividend cuts that has started to play out, but we do see a little bit more risk on the horizon. What else are we thinking about at the moment? Well, there's over 100 stocks on the ASX that are paying a yield of over 4%. There's over 75 stocks that are paying a yield of over 5%, and that's a raw yield, often fully franked. So you can gross it up, and there's a huge amount of yield and franking on the ASX, which is available for income investors. So we can dive into this a little bit more. We are focused on outcomes from a total return perspective, and we're not chasing yield and losing. We're aiming not to lose capital in the search for yield. So the real estate sector is a good example. You're getting a 4%, 4.5% yield, no franking, and you're losing capital along the way. So a good example in the retail space, Harvey Norman, a good example, paying a 6.5, 6.7% gross yield, but over the month it's lost 15%. So That's some specific examples, but a lot of opportunity, and what do we like at the moment? So a couple of stocks I'd like to dive into, which highlights our process at Solaris. The first of which is Suncorp. So at the moment, on our forecast, it's generating an 8.1% gross yield. So a really healthy yield, and there's several things we like. Number one, it has immediate pricing power, which is really important in this environment of inflation and volatility and a lot of moving parts. So Suncorp's really strong portfolio of insurance brands in AAMI and GIO, to name a few. The prices on premium rates are going up materially. So anyone that has home and contents insurance, you'll notice in your next bill a really large step up, which we don't like as customers and homeowners, but we really love as shareholders. The second aspect of Suncorp is the movement higher in yields. We've had over 300 basis points of cash rate rises, and there is more to follow. It means that Suncorp's large insurance float is going to be reinvested at higher yields, providing a tailwind to support earnings and dividends into future periods. The third aspect we like is the pending transaction with ANZ, which is going to free up Suncorp to really focus on insurance. It has a pending deal to offload its subscale, non-core banking operation and really focus on its higher returning insurance operation. So a lot to like, particularly from a yield perspective, but also from a capital perspective as we look forward. Coles is another great example in the portfolio. So a 5.1% gross yield, and Coles is very well positioned in this really difficult operating environment. So Coles got really hurt from a margin perspective during COVID. It was difficult to stack shelves, it was difficult to find labour, there was absenteeism and a huge amount of pressure on online delivery. So margins got crunched. As Coles emerges from the pressure during COVID, we see the potential for margin expansion and a normalisation in Coles' business. So we think that'll lead to market share, but really importantly margin, which is going to support earnings in a fairly volatile environment. The other aspect with Coles that's often underappreciated is they've spent over $1 billion in CapEx on their supply chain over the last 18 months. So a really great example up in Brisbane. So we're based in Queensland. They've got a really large facility coming online with over $400 million of robotics inside the shed, which completely removes increasingly expensive human labour from their supply chain. So that is yet to come online. Brisbane, Sydney, Melbourne are all more examples with Ocado and Witron, but that is yet to yield margin improvement and support earnings and dividends into future periods. So we really like a robust 5.1% yield from Coles. The third stock I'd like to highlight is CSL. So 1.6% gross yield. CSL at the moment is recovering from COVID. Its core collection business was really hampered as donors were afraid to go in and donate blood at risk of catching COVID. In the US, donors are effectively being forced to return and have the option of returning, driving collection volumes up 30% as stimulus programs are wearing off and paid donors return. So this is going to lead to a really big improvement in CSL's margin as we look forward. And it's a business that has a really diverse array of products that have very strong demand. The demand's not impacted by interest rates, inflation, any sort of geopolitics. It's just a really robust business paying a 1.6% gross yield. But I'm here talking about our focus on yield and our income fund, and we've got CSL in there with a 1.6% gross yield. Why? It's because of our focus on growth. And this is CSL and Telstra. So we've held CSL in our portfolio since inception, and we have not held Telstra. This is in our income fund. So why are we holding CSL? It's got a yield of 1.6% at the moment. Telstra's always had what looks to be a very healthy yield and a healthy amount of franking, but we haven't held it. Why is that? It's because this level of yield within Telstra's proved to be, it has been high over time, but it's proved to be quite unsustainable. We can look on the right and see what if we'd invested in CSL in 2002 and held it through to today. That yield has grown to be a 45% yield on the original investment, whereas Telstra's yield on that original investment back in 2002 has gone backwards. So it's now yielding less than it was in 2002. And this really emphasises our focus on growth. Within our income fund, we have a really strong focus on capital and capital growth in the share price, but also earnings and dividends over time. We can look at this another way. What if we'd invested $100 in CSL and $100 in Telstra in 2002? CSL has grown and reinvested to grow its earnings and to grow its dividends over time, and the share price is over 40 times higher at $4,000 today versus $100 in 2002. Telstra, which looked to have been paying a really great yield and a great level of franking, is actually worth $90 today. So the share price has gone backwards, and that is not adjusting for inflation, which would make it look materially worse. The yield on that original investment in Telstra has gone backwards. So this is one point that I'd really like to make and highlights our process at Solaris is we have a focus on yield, but it's this real deep focus on capital that we believe is key to investing for income. And it's why we believe that growth matters. So here's an example of some other stocks in our income portfolio that have got lower yields, but higher levels of growth in earnings and higher expected levels of growth in dividends as we look forward. So yield is important, but growth matters. So how do we invest for income at Solaris? Well, we have a focus on all stocks in the ASX 300, stocks that we forecast already have a yield forecast, a franking forecast, and an expected capital growth forecast. So it fits very nicely in our core process, which has been running for over 22 years. We've been managing after-tax mandates for over 20 years, and we have a very experienced team of sector analysts which are taking a view on the yield, but also the capital of all the stocks in our portfolio. We've generated a yield of since inception, 8.9% and 12.95% over the past year. That includes the benefit of franking, and have had good outcomes on capital and total return. So we have a strong focus on yield and franking, a focus on growth, a growth in earnings, dividends, and capital, and we'd like you to join us on our journey for income. So thanks for your time today, and Bernard and myself are down from Brisbane, and we're free to meet afterwards if you'd like to catch up and learn more about the fund. Thanks.